Good afternoon, and thank you for joining us today. I'm Taylor Combaluzier, a mining analyst at Red Cloud Securities. Today's webinar focuses on EDM Resources, which owns the Scotia Mine zinc-lead gypsum project near Halifax, Nova Scotia. The Scotia Mine is a brownfield permit operation with a fully built mine and mill with low-cost commercial production envisioned. Today I have with me on the webinar Mark Haywood, who's the President and Chief Executive Officer, as well as a Director at EDM. The format of today's webinar will be comprised of two parts. In the first part, Mark will provide an overview of EDM Resources. He'll then discuss recent activities at the project as it is advanced towards a potential restart, as well as recent corporate developments. In the second part, we'll take your questions live. So please send us your questions using the chat and we'll get to as many as we can. To start, we'll handle the disclosures and then get into the presentation. So for EDM Resources, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of the EDM corporate presentation located on the company's website. For Red Cloud Securities Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek out their own professional advice before investment. Please see our most recent research located on our website for EDM-specific disclosures. So with that out of the way, I will turn it over to Mark to give you an overview of EDM, and then we'll take your questions. So Mark, please take it away.
Thanks, Taylor. EDM, we've been around for at least 4 years since I've joined. We own the Scotia Mine, which is on a path to commercial production, and it's destined to have a free cash flow, annual free cash flow of about $13 to $40 million per annum for 14 years. So it's a long-term mine life. We've basically got mineral resources, mineral reserves. We're permitted in terms of the EA, and we're just finally finishing off all the approvals. And we expect to be in commercial production fairly soon. And I'm going to talk about that timeline update and the press release we put out last week on the latest information about that. But essentially, it's a long-term, long life of mine. C1 cash flow is very low. Starts off about 90 cents and then goes down to about 40 cents over the life of the mine. So it's a good little earner, and that's what I'm going to talk about today. As Tyler mentioned, we've got forward-looking statements, and I'm going to obviously make a number of those today during the presentation because it's what we're planning on doing and the work we've done to date and where we're going. So as an overview, the company EDM, we've had an amazing transformational value over the last 3 years, and probably about 4 years if you like. When I joined this, we had about $800,000 in debt. We had a mothball project in Nova Scotia, not permitted, had one main permit only out of compliant, and no resources, no reserves, and really no value. So that was part of the challenge, is to identify what we could do with the project and could we take it forward. So as most of you know, EDM is listed on the stock exchange and on the Venture Stock Exchange under EDM. We have a permitted and financed mine in Nova Scotia. The mine is not fully permitted. That's obviously a key point here, but we're permitted for 5 to 7 years under our EAs. That's environmental assessment approval, and they're the key approvals in Nova Scotia. The project under 43-101 pre-feasibility studies, we've done 2 of them. We have a net present value of over $174 million at 8% discount. So it's a pretty good value from, as I mentioned, when we took over this company 3.5, 4 years ago, had no value. So since that start to where we are now, we've developed a short path to commercial production. And we've always said that we're 9 to 12 months away from commercial production when we make that announcement. And that was part of our press release we did on last Friday. is to update the market on where we are in terms of that timeline, and of course when we think we may be in commercial production at the earliest point. So as I mentioned in the opening, it's a near-term free cash flow project, $13 to $41 million free cash flow per year. So it's a significant earner. We have about 150 full-time positions at the mine. We're just near the airport, so we're very well located in Nova Scotia from a logistics point of view. We're positioned for early and sustained dividends. That's one of the key aspects behind EDM. This is our only operation in terms of having a built mine and being close to going into production. Of course, like many other issuers these days, we're trading below our NAV, and that's the really EDM story about fixing that, rectifying that as we advance through to production. EDM is very close to the international airport of Stanfield International Airport in Halifax, and we're on major highways. Logistics is very good, from access to ports, access to the sea and rail, as you can see on the screen there, and of course we're nearby other operations as well, who also enjoy a good logistics being in that area. So that's one of the advantages when it comes to costs. There's a project that has essentially great logistics that enables us to have lower costs. And that's one of the advantages of EDM and the Scotia mine is our low operating costs. Our C1 cash cost is quite low considering the grade of the mine. And that's a big advantage in terms of the revenue, of course, and the overall value of the project. So logistics and location is one of the best you can see. Of course, we're in a tier 1 jurisdiction, Nova Scotia. This is a bit of a view of the mine, pretty much the same as it is right now today. The access road coming in the bottom left-hand corner, up to the infrastructure. We have offices, we have a built mill. It's quite a large facility. And you can see there is the old pit full of water, about 30 meters of water. Our plan is to pump that down gradually to the tailings pond, which you can see on the left, and then discharge in the river through the mill. So we plan to use that water in the mill for the initial operations. So we're actually using that water for that purpose first. So we're not drawing on different sources of water. We're using the water in the lake. And as we develop the pit along strike here, this is the northeast area. So developing along here and along the southwest, and that's essentially our main pit. And that's what we have our two main EAs in, environmental assessment approvals. And that gets us roughly 7 years of operations, which obviously pays back our loan and produces that kind of revenue I mentioned before, roughly $13 to $41 million of free cash flow a year. So it's pretty straightforward. As I mentioned, part of our plan part of what I mentioned previous times is our plan this year was to finish off the approvals for the operation, and that some of those are the Nova Scotian federal requirements, which haven't been an issue, but that's part of the press release I mentioned the other day. Is essentially we've had one of them slow down, and that's the Department of Fisheries and Oceans that slowed down due to some new requirements. So essentially this year is about getting the mine ready and ready for production next year. In terms of our path, the overall, I guess, production profile is a 14-year open pit, the conventional operation. Processing is conventional crushing, grinding, flotation circuit, dewatering and transport of the concentrate. We're financed through an offtake agreement with IXM SA. That's still in place. We have offtakes for the zinc, lead and gypsum currently, and we're working on another gypsum offtake, which which may provide another opportunity for revenue to the project, significant revenue to the project. So in terms of the production, we have expected commercial production to be as early as 2024 next year, probably Q4, with the delay in the permit or the approval from the Department of Fisheries, DFO. That's more than likely to be at the end of 2024 or early 2025. Nevertheless, that's an EBITDA cash flow, free cash flow of $13 to $41 million, as I mentioned before, over a 14-year period. So it's a pretty good mine with a long mine life. Our 2021 PFS that we completed at the end of 2021, that included a lot of the inflationary aspects of that at the time, and you can see it still has a very good low capital cost of being production because most of the facility is built. C1 cash cost on average over the life of the mine is 50 cents a pound, and that's based on $1.22 and just over $1 lead price and just under $9 US a ton for gypsum. So those prices have come off a little bit. The zinc price is floating around $1.09 right now, so that's below our 2021 PFS. And as I mentioned in our recent press release, we are obviously very, very cognizant of the margin between the C1 cash cost and the commodity price. So we want to see quite a healthy margin between what our forecast economics are and, of course, the metal prices, particularly in the first 4 years of production, where we've got to pay back our loan and obviously take into account any other contingencies. So that was part of the press release. We wanted to communicate to the market that all projects are sensitive to commodity price, and we want to make sure that when we go into production, when we announce that we're going into production, that we've got 14 years of clear runway ahead of us, or at least the first 5 to 7 in terms of the commodity price outlook. At present, we have the project finance secured through an offtake partner on the zinc and the lead. That's IXM out of Geneva. We're in constant contact with that offtaker. They've been a good partner to work with. Obviously, they've been appraised of the delay in the project, and we're discussing what to do in that regard and to extend the agreement. And that would obviously is what we're negotiating now. In terms of the commodity market drivers, I mentioned the zinc price is a key aspect of this project. It's one of the key drivers behind the economics. Lead and gypsum essentially are byproducts, which go to sweetening the overall economics of the project. So zinc is essentially zinc metal price is what we're watching very closely. We expect the trend back to above $1.30 to $1.40 to happen in the next couple of years. We want to see that upward trend essentially before announcing that we're going into production. There's no crystal ball out there, as you appreciate it, but working closely with an offtaker who has this pricing in place of long-term forecasts and access to that information. They've been a very good supporter of that, and they of course want this project to be successful and go into production and not have the hiccups once we're in production. So we're working closely with them on the zinc and lead price. We're working on a gypsum offtake. We already have one in place with the Nova Scotian group. We're looking at augmenting that with an alternative gypsum offtake, and to take advantage of certain conditions in the offtake agreement with IXM that would benefit the project, and particularly the condition precedents that most of the group know that have a requirement before we can draw down on the loan from IXM. So we're working, and we have been working diligently over the last year and a half since we put that agreement in place to check off the condition precedents for that facility, and we've been progressively, obviously, working those through, and been quite happy with the progress. But we still have ways to go, and part of that is dovetailed on the timing. So when we have those CPs in place, condition precedents checked off, then we feel that would be the time to announce the project going to production. The exchange rate, obviously, we expect it to remain about 75 cents, which is a good long-term average for the project. Upcoming plan catalysts, year one will start basically on when we start mining. And as you can see here on the right-hand column, the EBITDA forecast, year one to year three, that's $60 million of free cash. Out of that $60 million, we pay the loan, which is roughly about $40 million. So we have considerable free cash at the end of the 3 years that we can use towards paying a dividend, which has always been our strategy. After year four, of course, the EBITDA from 92 million for the next couple of years, and so on, and until the end of mine life in year 14, and that's basically a free cash flow. So no loan. It's just basically clear revenue and profit into the operation that we can use to pay dividends out of. So this is a significant earner over a long-term period, which is why we're quite excited about this project and why we've been investing our time and resources into ensuring that we have a long mine life ahead of us. Capitalization, we did a financing recently, and we're fully diluted now to 30 million shares, partially, or shares outstanding is about 24 million. With the recent announcement, we obviously had some selling, which is of course disappointing due to the announcement and the delay. But our market cap is roughly $4 million, with a net present value of a project of roughly 174 million at 8% pre-tax. So we're trading well below NAV, and as we've always said, this is a great opportunity to be a part of this company as we complete these things and get into commercial production, and then we should experience a re-rating. I think that's it, Taylor, in terms of just an overview. This presentation has a lot more information in it, and I don't propose we go through that detailed technical aspects. But if you'd like, I'd like to focus on essentially some of the updates we've got, like in terms of the news release that we put out last Friday.
Sure, sounds good, Mark. Thanks for the presentation. So now we'll turn to the Q&A portion of the webinar. Just a reminder to everybody on the line that you can type your questions into the chat box now. So I guess let's start off with some of these some questions here. Quite a few have come in just referring to the costs associated with the project in terms of all-in sustaining costs, cash costs, etc. So maybe we have one here just wondering, you talked about the C1 cash cost, but what is the all-in sustaining cost? Do you have those figures?
Yep. Off the top of my head, in the 2021 PFS, the C1 cash was around 50 cents a pound US. The all-in sustaining, you add another 2 cents onto that. So not much more, but everybody knows that in 2021, the costs at that time, we've experienced higher costs. So we would expect to, once we're in production, and let's say we did that the 43-101 update now, we'd probably have a little bit higher, but not very much. But we've also done a lot of work with the off-taker on that financial model, internal work. And what I can say is that some of those initiatives that we've been working on are actually going to improve the economics of the operation. Some things such as we're looking at solar and wind power, and also compressed natural gas power to supplement or as an alternative to grid power, which everybody knows is going up and at alarming rates. So we want to offset a little bit of that with some green energy, if you like. The other thing is we're looking at density media separation in the mill, which means that we can upgrade the ore coming into the mill by 20 to 25%. So that's a little project we're working on. That essentially increases the head grade of the operation. And you increase that with the same throughput, then you basically make more money, right? And so we've been looking at that. We're also looking at optimizing various aspects of the crushing circuit, a new crushing circuit that's saved money in terms of the overall capex of the project that was identified in 2021 PFS. So a lot of things that are happening in the background, and we're continually working on the project to put downward pressure on the C1 cash costs. I saw another question, if you want me to answer. I think there was a flow on from that, Taylor, that when we start, naturally the C1 cash cost is higher for the first couple of years, and that's natural for most operations. You're stripping waste. You're not producing any ore. Some of that's capitalized, but you have a higher strip ratio. No different for this project. We have a high strip ratio, and once we get through that and really expose the ore body and maximize the head grade, which is between 2 and 2.5% zinc, then you basically have much lower costs. And so, if you like, the profile to start is around between 80 to 90 cents a pound, US dollars a pound zinc, and that's C1 cash cost. And then after 3 years, 4 years, I think it is, it drops down to 40 cents. So there's ways that we're working on in terms of short-term planning to improve that profile as well. And so, as you can imagine, PFS studies are fairly coarse. We're doing a lot of mine planning right now to improve that. So we may start off with a significantly lower C1 cash cost in the first 3 years. So these are the kind of things it's a great little project. It's robust, but we also want to see that margin between the C1 cash cost and the commodity price greater. No, nobody wants us to put this into production and have to shut down because the commodity price is below our C1 cash cost. So these are the kind of things that we're working diligently on to try and improve that cost profile, particularly in the short term.
Okay, and I guess with that, there's related in terms of the zinc price outlook. We have some questions just kind of wondering, what's the scenario, if prices stay kind of range bound to where they are now, say $1, $1.10. Is the project able to go ahead at that level, and what would cash flow look like under that scenario?
Yep. So at $1.09, I think it was zinc price the other day. The long-term forecasts are showing $1.30, but the short-term to medium-term forecasts, this is the usual street we use, and plus our off-tracker, that's below $1.20, and so the project still makes money, but it increases the risk. And of course the return, our ability to repay the loan. We could still operate if the price was, say, 90 cents. We would still make money, but we wouldn't make much. But it would be enough to service the loan. But let's say you had a drop in price and it fell for some crazy reason down below that, then we'd have to pause the operation, and that's problematic in the start of an operation. If you've been in operation for many years and you build up a big treasury balance, then yes, you probably could absorb that and do things to offset that. But when you're starting, it's critical time. And I've operated enough mines that that you've got to be conservative to a point, and you've got to make sure that you have the legs to go the distance. And that's really what we've been monitoring with our off-takers. Is now a good time to go in production if we've got everything in place? Do we want to announce today? If I've got, and I can talk about some of the news release and the other things we're doing in 2024, but 2023, do we want to say, yep, we're going to production, and we'll get this permit from the DFO, which we're expecting over summer this year, and it'll be fine. We'll take that risk and we push the button. After discussing this with the off-takers and with my board, we felt that we would rather let the market know and let our shareholders know that we're continually monitoring the situation and how an upward trend in commodity price is important for us to make that go decision. So commodity price has a big factor in it. The gypsum, would you believe, is come up in value in dollars per ton, and so that's added considerable revenue to the project and made it even more robust. And the things I'm working on, which I can't really say right now, in terms of working with another gypsum off-taker, quite exciting in terms of what impact that could have on the project. But of course, we're not ready to we haven't signed anything. We haven't got anything to talk about really, other than we're working on these things, and like we're always doing, we're looking for opportunities to improve the robustness of the project. So just to cap that off, yes, if the zinc price is below $1.20, I'd be reluctant to say let's get it in production and then have to be exposed to a commodity price that's falling and have to put everything on hold. So once you make that announcement and you've got trucks, you've got 150 people on the mine site, you're burning a lot of cash. If you don't have that cash, you're going to go bankrupt. And so this is what Acadian did. They rushed into production. They had a high cost matrix, and they didn't make it. And this is what EDM bought. We bought a project that was built, not done, not upgraded, if you like, to an open pit operation, fixing all the bottlenecks, fixing all the issues before going in production. And that's what we've been intent on doing, is fixing it, getting ready, and then pushing a button. And really, this is what 2023 is about. Getting all these final approvals in place. We've communicated to the market since December last year. We had both the EAs, which are the main permits in order to get in production. There's a whole bunch of permits that are local things, from blasting to soil erosion. These are all very, very minor, but they just require us to do technical reports and do submissions, and the regulators have a view and they have time to review them and ask questions. And so that's why we've always said that this year essentially is about getting ready to go into production as soon as we can. Yeah.
Okay, and with that, I guess just before we get to some of these more questions, what outlook do you have with the zinc market in terms of long term, that you think that would, as you said and explained, kind of you want to see that upward trajectory, and you want to kind of have that confidence. What do you think will drive that down a little bit?
Well, our economics have done on a long-term zinc price at $1.20, and right now the forecast for long-term is $1.30. So I think that's a good sign. It's such a short to medium-term forecast with what's going on in the world, economic woes and things like that. That caused me to step back and say, are we ready yet? The long-term forecast for zinc is well above the economics of the project. So as I mentioned, 174 net present value on our last PFS at 8% discount. That's pre-tax. Under $1.30, it's much higher, right? And the other things we're doing, as I mentioned, to potentially increase the head grade in the plant, green energy, things like that, they all go towards reducing the operating costs of the mine. And so long term, I think we've got a great project. And of course, like I've lived and breathed this thing for quite a while. I think it's actually pretty much 4 years now. So I think I know it pretty well backwards and forwards. I'm on the site relatively, most weeks, and in touch with my team there. It's still a great project, and I think the press release we put out last Friday was, in essence, a negative press release, but I think most of you know that I'm pretty transparent and what we need to do and communicate to the market. And I wanted to let people know this is our situation. Are we trying to do everything we can to make that faster? And have we? Yes, of course. Part of the reason why I'm in Nova Scotia a lot is and living here, if you like, is because there's a lot of things we can do to help that from a political point of view, engagement with stakeholder point of view. So in no way do we believe that this is over and people should exit out of this opportunity. We still feel very strongly this is a great opportunity, and it's just like most projects. You have left field delays, unexpected, and you sometimes get blindsided. Like none of our permitting people knew of this change of requirement and the extent of that. So we just have to work through it. It's a procedural thing.
Right, and we do have a couple questions just relating to that Department of Fisheries and Oceans requirements for that environmental work. Maybe just explain kind of what changed, and is there any major cost associated with completing those requirements?
Yeah, so the DFO, Department of Fisheries and Oceans, they have a blanket kind of thing about rivers and the impacts of operations on rivers. And we have the Gaze River that flows past the mine. It's a seasonal river. 3 weeks ago, we had unprecedented 100-year storms. This river went up to like 4 meters or something above its normal level. In summer, it's normally a trickle, and when you get spring runoff, you get increased flow as well. So the range of this river is quite extreme, and it doesn't host. There's no evidence that it hosts Atlantic salmon. The river's too hot. There may have been Atlantic salmon there many years ago, but in the last 10 years, there's nothing. So the DFO wants us to confirm there is no Atlantic salmon there. So we need to go fishing. And although we've done fishing and identified species in there, there's no fishermen fishing in that area. 6 kilometers downstream, where the Gaze River intersects the Shubenacadie Canal System or Shubenacadie River, I think it is, then yes, there's salmon there, they fish in there. But this is up quite a way upstream from that point, and it doesn't host salmon. Has there been, there's no evidence of it. The mine operated successfully in the past without impacting anything. There's another species at risk called the Brookfield floater. These things the mine's been operated before. This is one of the reasons why we were kind of blindsided, because they want us to go fishing on this kind of stuff and prove that there's no species. If there is a species, then you have to offset the impact you have in there. Because the mine was only operated 10 years ago, it's kind of crazy that we have to do this, but this is what I'm saying. Part of a new requirement, the SARA, Species at Risk Act, is essentially a relatively new thing, and the feds, the DFO believes that we have to prove to them again. So that's why it's the requirements change. It is a seasonal river, as I mentioned. Project's been operated before. It's had this approval in place before. It's been a very interesting couple of weeks, I can tell you, as we've gone through that, and our independent permitters, our experts in this area, they were blindsided as well, and so they do permitting for all over Canada, and so this is a very new thing, and it's basically caught us all off guard. And I think for some of the investors and shareholders have reached out to me and said, what's going on? I've been the most, damaged by this in terms of disappointment and being upset. So we believe there's a solution, and largely that is essentially field work over the next few seasons. So summer now, of course, fall, winter, and spring, and then we'll be submitting the full application to DFO, and we expect that to be returned pretty quick, and that's part of our engagement with the feds, which we're doing right now. One of the reasons why I'm here, of course, and so we may get their approval in summer next year, early summer, and then we can push the trigger, because I believe that we'll have everything else in place by then, as I've communicated to the market before. The things that we've been working on this year, 2023, it's quite an substantive list, including the $5 million contingency amount, which is part of the offtake agreement requirement, the condition precedent. So all these things we're working forward, and by no means do we believe that the DFO basically put such a spanner in that it's time to get out. No, we believe it's just a procedural thing. That's what our experts are saying. We've just got to work through it. It's going to take time and patience in terms of navigating that. But we have a great team on site. My environmental permitting team, and of course our consultants and our field team as well. So I think we're in good hands, but it takes time.
Right. So it sounds like more of a time investment rather than a capital investment.
True. Yeah. But there is obviously a cost of sampling. We still have a fairly healthy treasury balance. We can tap into the insurance, the cash bond we have with the government. It's $3 million. That's non-dilutive. And so I have essentially that in place for insurance. It's a surety bond, and that effectively gives us $2 million cash into the treasury. I'm also working on another opportunity. I won't talk more about it right now, but all of these things, what I'm trying to do is preserve our cash and make sure we've got sufficient cash to get through this year and get through this permitting, and I don't expect to have to tap into the equity markets for that. As I've said many times before, I've been trying to keep dilution to a minimum. We've only raised really what we've needed to get to the next level, to the next step, if you like, getting to commercial production, or getting the permitting done, or getting whatever. And for a company that has basically 24 million shares outstanding and a project of net present value over 174 million, and this close to commercial production is pretty unique. And as you know, Taylor, in terms of your technical work on this DFO thing is basically just a delay. We see a delay. Yes, zinc prices are not good anyway, so maybe we would have had to delay it by 6 months or 12 months anyway. And I think all the shareholders and stakeholders would say, yeah, Mark, don't put this project into commercial production on a low zinc price. Please hold off, right? But maybe we've made that announcement and we've pushed the trigger, and we've got a high burn rate. At the moment, we have a very low burn rate for a publicly listed company and with a mine. So that's a good thing, to be a good position to be in before we've actually made that announcement and extended that and made those commitments. But having said that, we've also been looking at the long-term lead items of the project that need to be ordered, and we have ordered those filter plates, and so they'll be ready in February or something next year. So great. What other lead items are there? None, right? And so that in itself creates de-risking the project by extending it by 6 months. It means that other things are still being lined up, and we're working diligently on making sure that they are still in a good position on our timeline. And I guess I can talk more about the timeline if you want, Taylor.
Yeah. So I just highlight there. That could be a silver lining for the overall situation, that these things line up, as you said, with the current zinc price level and the permitting delays. So it is looking at the bright side, it's kind of lined up to work out to be together rather than stacked on and exacerbating either situation. So
yeah.
But if you want to discuss some of the long lead items, that would be good.
Yeah. So the long lead item is the filter plates that are manufactured in Germany. We expect them to come in February next year. The other things that we planned on doing this year, which I've communicated to the market before, is the engineering work by Ausenco for them to go through the mill in detail and just have a step back and say, is this the right thing to do? A bit of hindsight and time, like stepping away a little bit from the PFS in terms of, can we do it better? And they've come up with some great ideas. And I'm basically over in the mill every week, maybe every second week, looking at things, and of course taking visitors through. And there's lots of opportunities we can incorporate into improving the mill in terms of in terms of recovery throughputs and basically the overall production of concentrate out of the mill. So that's one of the things that Ausenco have been doing. Also, we've been doing a lot of detailed mine planning on the operation, and to see, as I mentioned earlier, see if we can get the strip ratio managed a little bit better. Maybe reduce our initial C1 cash cost for the first 3 years and smooth that out, and create a bigger margin between the cash cost and the metal price. That's the detailed planning. We expect to finish that in September this year. We've done most of the preparations for hiring over 150 people. We're also having a community day next month, September the 9th, on the mine site. That's really to continue on creating the awareness, engaging with the community, engaging with First Nations, the Mi'kmaq group, and other First Nations parties in the area, to make sure that we're doing the right thing. Of course, engaging with stakeholders, engaging with the Nova Scotia government, and as I mentioned, potential workforce. We've been working on all the other regulatory approvals from Nova Scotia to the feds, as I mentioned, for the DFO, and that, I think that's coming along. We expect to have them in place by the end of this year, and maybe even earlier, aside from the DFO, as I mentioned before. We're working on that. We have roughly a $40 million bond that will be exchanged for a surety bond when we're ready to go. At the moment, we have a $3 million cash bond with the government of Nova Scotia, the finance department. That's the cash that we can use for the project. And as I said, that's non-dilutive. And for the cost of ensuring that, it's like something like $30,000 a year. So why not use that? We can use some of that towards permitting. And I see as a question on how much the DFO work will cost. We don't think it's going to be significant enough to talk about it right now because we don't know. But we're getting a quote on that from our permitting agent. It's really just sampling 4 seasons, and they're going to do it next week. And then we put it into an application, and here you go. And so there's other things we need to do in terms of just putting that all together in a package. And so we don't know exact cost behind that because it's new. But we don't. That's why I'm intent on making sure we have the capital available to cover that. These things aren't typically very expensive, but this takes time, and we've got the right group of consultants, we think, and contractors available to do that work in Nova Scotia.
Perfect. Okay. We do have some questions and several questions just wondering about the IXM agreement. Essentially, what are the key terms there? Is it binding or non-binding? Is there a risk that the off-taker could pull out? And if so, are there any interest from other off-takers?
Yeah, in terms of the agreements with IXM, we have 2 commercial offtake agreements, one for zinc and one for lead, and I can't talk about those terms. They're confidential, but the credit terms, essentially, it's a loan for $24 million US. We pay it back over something like 33 months with an interest rate, and the interest rate is SOFR. Standard overnight finance rate plus 6%. So when you put all that into a model, we essentially, it's about $900 to $1 million a month for 30 months, and so essentially we pay that back off over the first 3 years of the project. There's a grace period from when we first draw that down. So if we draw it down on say month 1, we don't have to start paying that back until month 9. And because we have a fairly short time from mining, from stripping, it's about 3 months, and we draw that down on essentially month -4. Start mining, 4 months of mining, turn the plant on, start making money. So 5 months after we start making money, 5 months of revenue, if you like, then we start the repayment. So that's the 9-month grace period. So that's pretty good. That basically gives enough time to build up a pretty healthy treasury balance before we start paying that back. So that's how it's been structured. Typical terms of finance, there's in order to draw down on that, that's the condition precedents I mentioned earlier. We have a number of different conditions, and that, of course, inside that credit agreement, one of them is having the necessary permits in place to start. We don't have to have all the permits. We just have to have the necessary permits in place, and that's really why we've always been talking about the EAs. The EAs for the first 5 to 7 years of production from the pit, because we pay back the loan and they'll obviously make significant revenue over that period of time. So other terms essentially are typical finance terms in terms of repayment, default, all those kind of things. And so that's why we've been working very closely with IXM. They've been a great partner. The terms of that, of course, are continual due diligence of the project, and that's why we essentially have bi-weekly meetings with them to go over changes and to their satisfaction. So yes, can they pull out of it? We think they won't. There might be a change in some of the terms due to the delay, but these have been very good group to deal with, and as most of you know, they're a lot of other off-takers around if they decide to exit. And obviously when I did this process before, I was negotiating with a lot of other off-takers who are out in the industry and are well known. So I hope we can continue our relationship with IXM. I think it's been pretty good. But that's really where we stand right now. So there's no change. They know about the delay, and they're obviously contemplating, what changes they would like, and we'll probably enter discussions on that basis in due course. At the moment, as it stands, we need to draw down on that first amount and complete the CPs, condition precedents, by the end of this year, which we're not going to make. And so I've communicated that to them formally, and they'll be getting back to us in due course on that. But that's where it stands.
Right. Okay. I think it's got a couple left here that I can see. Maybe just one. We discussed commodity price, obviously, permitting, etc. Are there any other unique risks that or headwinds that you kind of foresee, and how are you planning to mitigate them, if there's any, kind of aside from the ones we've discussed already?
So I think a lot of people have inflation on their mind, and so we want to know, is this project going to blow out? And we have, in the 2021 PFS, we had in the order of 31 million Canadian. The finance with IXM was 24 million US, which is more than that, roughly. The exchange rate 34 million, I think it is, it stands. The additional 5 million contingency for ramp up, I've added an extra 5 million buffer into that. So effectively, we're pretty close to let's say 40 million. $40 million Canadian, I think 38, be precise. So 38 million Canadian at hand for a project that in 2021 had forecast capex requirement of 30.8 million, which included a $2.7 million contingency already. So the work we've been doing over the last 2 years, if you like, with Ausenco and with our team and with the off-taker has changed that and put a downward pressure on that price. I mean, obviously we haven't put out a 43-101 on that, so I can't talk specifics, but it's improved the project and de-risked it from a capital point of view, and yet the loan and the other conditions are still at the 38 million. So that is a risk that metal prices, steel prices remain high, and some of that capex it is higher than even our internal review has indicated. But we still have a heavy buffer, pretty heavy buffer in there. So that's always a risk. I think permitting is a continual process of compliance and remaining in compliance. We're doing obviously a lot of sampling. We spend about 50 grand a year on sampling rivers and doing reports and to make sure that those EAs in place. We have a main EA, and then we have the Southwest Extension EA. That's up for renewal again September next year. So we're going to start that process of renewal early on now, because we don't know whether we'll have the DFO done by then. But we just need to basically have the bond in place and grub by the 15th of September next year, and that permit gets that EA gets completed, if you like. So we're working on that. If we feel that we can't grub, and grubbing is essentially just removing some topsoil, not extensively over the southwest area, but over a portion of it to satisfy that condition, then the EA is done, essentially. If we feel that we can't do that or we don't want to do that, or we want to stage it. As I said before, from a mine planning point of view, we could mine in the main zone and then extend that out and delay some of that. That might be also a strategic opportunity for us to consider. But again, there's a multitude of little things, or low-hanging fruit, if you like, or low risks that we're continually working upon to reduce. And of course, some people have asked me, are we a takeover opportunity, considering our the value of the project and our market cap? And I say yeah, and of course we are. And has this happened? Have we been approached before? Yes. Will it continue to happen? Probably. Is it realistic that we anything be reasonable to present to the shareholders? We'll have to just wait and see. But really, it's crazy. It's really crazy that where our share price is now and the value of the asset. So obviously we appreciate some people have been spooked and by the news. But as I said, like we have to be transparent. And for most of you who know me, that's just basically, this is the game. Is that this is a situation. Want you guys to know about it. I still think there's an excellent investment opportunity to be part of this. And as we take EDM from or the Scotia mine from a mothballed project worth nothing, 4 years ago, to a project in operation, and hopefully that's going to be at the end of next year, maybe Q1 2025. We just have to focus on that permit. I think everything else is pretty much going to be in place at the end of this year or near after that.
Great. Okay. Just a quick question here. Just somebody wondering if the Gaze River, where does that drain into?
The Gaze River joins up with another river and goes into the Shubenacadie River, I think that's called, which is 6 kilometers or so downstream from the operation. Our Gaze River is a very shallow river. I would call it a creek, a seasonal river, if you like. It winds its way past the project. It's not a significant thing. That's why basically we don't see Atlantic salmon in there. But the default is any river, Atlantic salmon, right? This is part of the blindsiding change that we had, is that, okay, like get your highlighter out, all of Nova Scotia has Atlantic salmon. Yeah. But most of us know that not all rivers support that. Anyway, these are the hoops that we're going to have to jump through. And as I mentioned, we see that as a process. Our experts have said that the process, we may have to do some offsetting. If there is something there, which would be, like there's no indication at all. I think there was Atlantic salmon in the distal past, like prior to Acadian operating, but there's certainly no evidence now, and nobody's caught anyone there, any salmon there. So this is what they want. We've tried to address that to them, but it's this is what you guys got to do. So that's why I'm saying it's been very disappointing, and of course we had to tell everybody about it, but we don't see it any way killing the project. It's just basically a delay, and I would ask investors that just be mindful of what we're doing and what we've done already. I think my team have done excellent work to date and getting us to here. And there's still, of course, a lot of work ahead of us. Our plan is to get this into production as soon as we can.
Right, and maybe in that vein, just before we wrap up, maybe if you could discuss some of the exploration work that's been ongoing. You mentioned that in the update that came out, as well as any other share price drivers, kind of in the interim as you work diligently on the getting ready on the development side.
Yep. So we have two pretty good prospects on strike. one of them in particular, on strike to the project, which we're doing work on right now. That's the Getty and Carroll's Corner area. We're using a group to work that. We also have results coming out of that probably at the end of the year. That's all about identifying additional mineralisation that we can truck in to the mine. We've already got a 14-year mine life, and most of you know the resource to reserve conversion is pretty low, which means that there's tremendous upside in increasing that conversion. So if you like, some of the resources can go into reserve, which would extend the mine life. And some ways you can do that is through reducing our costs, reducing the cutoff grade, essentially increasing the amount of tonnage that we mine, and then dovetail that with improvements in recovery, the density media separation opportunity I mentioned before. That's a really good way of improving the grade after you've mined it. And some people, if they don't know what that is, that's essentially separating out some of the waste from the ore in the plant, so you don't have to crush and grind and float waste. So one way to do that is by density media separation. So if you like, a rock of zinc weighs a lot heavier and sinks to the bottom of the tank, if you like, as opposed to a particle of dirt which would float on top. So you separate those out, and which means that then you start grinding and crushing, grinding higher quality or concentration of ore, which increases the grade. So these are the kind of things that are quite interesting. I see a question there. Do we want to update the PFS? It's possible. We had thought that once we announce going into production, we've got a certain number of months, then we would update the study. But because we've been working very closely with the off-taker internally, and they're really our finance group, we've been, obviously have had no need to do a separate 43-101 on that. It takes time and obviously costs money. So we've been trying to conserve as much capital as possible and focus on what we need to do, which is those items I mentioned before. Focus on the 2023 items, getting the mine ready, checking off those condition precedents to getting into production as soon as possible. And I feel that we still would have been able to reach that if it wasn't for the DFO situation. So other than that, I think we've been going great. Obviously, share prices hasn't been performing. We've been looking at some other opportunities. That's one of your questions, Taylor. Other than exploration, regional exploration, we've been looking at the market. We recognise that the Canadian retail market hasn't been very strong lately. Maybe some colourful metaphors are applicable there, but we've been looking at should we do a listing in Germany, in Frankfurt, and increase the depth of our following. Some of these things have been bandied about, and so we're considering that as well. In terms of drivers and forward-looking statements, yes, I think there's a number of things that while we're going through this work, I think there's a number of different things that I have in the pipeline that could help us, help the project, but also help EDM in terms of getting to where we need to be, both in recognition of what we're doing and in terms of our overall goal, explore, develop, mine. And as you know, there's great opportunity to leverage a facility which is built and has industrial approvals in place to mine zinc and lead and process that. We could also do other things. And some of our shareholders and investors might realise or know that this used to process gold as a toll opportunity. So maybe they're the kind of things that we'll have some joy out of that if we have to delay by a year. The plant's built. All we're doing is putting new equipment in there, upgrading it to 2,700 tons a day, improving the reliability of it for the long term, and that's part of that $30 million I mentioned. And so, can we do other things with that while we're waiting? We're looking at that as well. Are there other more exciting other things we can do in terms of the overall project? We have sand and gravel which we don't monetize. That could be incorporated into something as well. I think that it's a great project, and we'd encourage you. We've got an AGM on the 24th of November. If any shareholders are in town, come see the mine, or we can organise other trips as well on a case by case basis. So it's a great location. I think it's just a matter of working through these procedural things, keeping a close eye on cash, and then keep on doing what we're doing in terms of this timeline, communicating to the market what we're doing. It's a pretty unique situation, I've got to admit.
Great. Okay. We do have one here that I'm not sure it's been explicitly addressed or not, so I'll just ask you again and see how it goes. How will EDM go about satisfying the $5 million contingency requirement to be able to draw down the IXM debt facility?
Okay, that's one of the key aspects of that credit agreement is that in order to draw down on $1 from it, we need to have a standby facility for ramping up during commercial production, essentially. So once we draw down on that 24 million US, we use that, and if we get short for some reason, there's a delay in revenue from sales of concentrate, and we don't have sufficient treasury balance to pay working capital, then what we agreed with the off-takers is to have another facility in there to basically cover payroll, cover costs until we have the revenue in there. So that facility, I've been working on that for a year and a half, and I've got to say, it's looking good on that. I mean, I obviously can't say too much, but I've been working on that as a non-dilutive instrument. We don't want to raise capital. We don't want to raise $5 million in this market or any market really, because it's so diluted to our shareholders as a standby facility. Like, it's only there for the ramp up, which is essentially 3 months worth of starting the mill and getting it through to commercial production, and then it doesn't have to be there anymore. So that's why the beauty of it is essentially as a non-dilutive standby credit facility that hopefully we won't even use. So that's how I've been working on that one. Have anything been finalized? No. Otherwise, I would be communicating that to the market. And if it does, then you bet there will be a news release out on that, because I think that's one of the major CPs that people have been waiting for us to hear, to communicate, if you like. So I'm still working away on that. Although the DFO thing has slowed us down in terms of a start, I think all the other things that you can imagine we're working on to make sure we go into production and stay in production, we're still focused on. We're still working 24/7, if you like, on achieving those timelines. We're just a bit delayed. Yeah.
Okay, perfect. Yeah, no, that's good to hear that there's some creative options that you can do there, and not just have to raise dilutive capital to park it. So it's there on standby. Perfect. Yeah. Okay. I think we've hit all the questions that have come in here, and I think that's been a good update for investors today. So I think with that, I would like to thank Mark from EDM Resources for taking the time to host the webinar today with Red Cloud Securities. And thank you very much to everybody on the line for tuning in with us.
Thanks, Tyler. Thanks, everyone.